Good afternoon, everyone, and thank you to CFA Society Minnesota for having us here today. My name is Jared Organ, and I'm joined by teammates Luke Eggleston and Bailey Solvay as represent the University of Wisconsin River Falls Team 1. We're excited to be here today as we present to you Sun Country Airlines. We are issuing a sell recommendation on Sun Country Airlines with a 12-month price target of $13 or $9 per share. This implies a downside of 19.96% from last Friday's close. We can do this valuation using a three-source model comprising the multiple model, the Benjamin Graham model, and the discounted cash flow model. Our investment thesis is based around three main components, those being barriers to market growth, low forecasted growth outlook, and Apollo global expansion. I'll now pass the mic off to Luke as he will cover Sun Country's role in the aviation industry.
Thank you, Jared. Sun Country Airlines, headquartered out of Minneapolis, Minnesota, establishes itself as a new breed of hybrid low-cost carrier, conducting business across three main segments. The first being scheduled service with focus on low-cost, leisure-focused travel for passengers, the charter segment, which tailors air solutions for customers, and third and finally, the cargo segment, which has dedicated aircraft services for Amazon Air through long-term contracts. As for the budget carrier industry, they all minimize costs while also maximizing efficiency in the market in order to provide the lowest possible fares for customers. Sun Country and its competitors such as Spirit, Frontier, and Allegiant Airlines all operate high utilization models with focus on quick turnarounds as well as point-to-point destinations. Now I'll hand the mic back to Jared with our first proponent.
Thank you, Luke. Our first proponent is how low barriers to market growth at MSP will affect Sun Country's ability to expand their operations. Sun Country has the second highest passenger share at MSP behind Delta. In 2024, they held 11.5% of the passenger market. Although they have a fair-sized market share at MSP, they only hold 1% or more of the total passenger share at one other airport, this being Fort Myers RSW, where they hold 3% of the total passenger share. Their low passenger share at other markets has helped keep their Sun Country low and expanding their operations, and this will affect their ability to expand profitably. MSP runs through Delta, and this is something that Sun Country is aware of. Minneapolis is one of Delta's 9 hubs. On the left, we can see comparable hubs to MSP, where Delta holds one of their major airports. In these airports, the largest low-cost carriers account for 12% of the total passenger market. This has helped keep Sun Country out of these markets. To identify this, Sun Country is staying into these roles into the future. Coming from this, we can see that the largest low-cost carriers account for 12% of the passenger market, which leads into the next step of that being Sun Country being which leads into the fair war with Delta. With Sun Country and Delta competing for profitability, Sun Country has to step up their price gap between their low-cost carriers and the legacy carriers such as Delta. This has helped keep Delta's profitability low and expanded into the future. Stemming from this fair war has kept Sun Country's revenue low, as their Q1 2023 revenue to Q1 2024 in the scheduled service sector fell 7.5% and net income 7.9%. This fair war can still be seen in MSP today, and will affect Sun Country's ability to expand operations into the future. I will now hand off to Bailey for proponent 2.
Okay, thanks, Jared. Our second proponent is underperformance expected amid a low single-digit growth outlook for the future. Decline in revenue in 2025 is stemmed from a drop in passenger flying, as well as lower than expected cargo block hours. We see a 12% reduction in passenger flying, reducing revenue in the segment by $115 million. We also see cargo block hours increasing 61%, driving revenue by $63 million. However, full-year revenue is expected to fall by $59 million to $1.069 billion. Passenger revenue remains the largest driver for margin. We see gross margin falling by 5% to 26%, with all margins following suit besides free cash flow, with free cash flow lagging 1 year behind. This is due to higher CapEx costs in 2026 with the addition of 7 new passenger aircraft. We see net margin hitting 1%, driven by gross margin decline. We also see an earnings per share CAGR of 3.18% through 2029. I'll now turn it over to Luke for proponent 3.
Thank you, Bailey. For proponent 3, I'll be talking about Apollo Global Management's exit, as well as how this will weaken the stock price performance for Sun Country's future. Apollo Global Management, the alternative investment firm, acquired a majority stake in Sun Country Airlines in 2018. In In March of 2021, Sun Country had IPO'd, giving Apollo Global the equivalent investment of 40.9 million shares. Post-IPO, Apollo began to sell these shares in excess quantities, therefore moving the market against them so significantly in the downward direction. Recently, on February 10, 2025, Sun Country had announced the pricing of a secondary public offering consisting of the remaining 6.3 million of Apollo shares in ownership. This shows that Apollo is prioritizing liquidity over long-term investment in Sun Country Airlines, making it a red flag for new investors. Sun Country is participating in a $10 million share buyback, only eclipsing to 9.41% of the total sale. Institutional exits of this caliber often lead to significant stock price declines due to the excess and oversupply of stock entering the market. Apollo here is mirroring past private equity exits along the airline industry as shown on the right, which has significant downward pressure on the stock market. Now I will hand the mic back to Jared for an ESG.
Thank you, Luke. Sun Country has an average ESG score of 31 out of 100. This score is comparable to that of their peers. The firm lacks particularly in the environmental sector. This is due to their lack of SAF implementation as well as sustainability efforts. Additionally, Sun Country's aging fleet reduces fuel efficiency and thus increases carbon emissions. Sun Country has the second lowest employee approval rating amongst comparable budget carriers. This stems from ongoing contract disagreements with represented unions. The executive management team consists of 10 members. The tenure of these 10 members consists from 1 to 7 years. The board of directors is composed of 8 members. Of these 8 members, 4 of which are female, which puts Sun Country above the average board representation of 29% female for the industry. Despite this, the board lacks ethnic diversity, which affects their ESG score. Using a pay-for-performance sensitivity chart, it is noted that CEO Jude Bricker is comparable to that of peers when looking at performance compensation. Bailey will now tackle our valuation model.
Hey, thanks, Jared. I'll now tell you about a resource valuation model. Our first component is the multiples valuation. For this, we give it a 10% weighting to ensure our main component was accurate in its assumptions. We compared metrics with competitor Allegiant Air. This allowed us to compare Sun Country with a fellow competitor to help form a general benchmark. For this, we get a target price of $13.14. Our second component is the Benjamin Graham valuation. For this, we gave it a 20% weighting to help reinforce the estimate of the multiples valuation. Given the fact that Sun Country has no dividend, the use case of another model became apparent. Also, today's interest rates of 4.25% to 4.5%, and the AAA corporate bond at circa 5.5%. This allowed us to incorporate the cost of debt into our calculation. For this, we get a target price of $13.27. Our third component is the discounted cash flow model. We gave this a 70% weighting due to the nature of its complexity and ability for us to incorporate key financial metrics into our calculation. For this, we use a 2-stage model. Our first stage of growth of 3% growth found through our CAGR through 2029. Our second stage, a terminal stage of 2% growth to 2037. This is due to the potential extension of the Amazon business. For this, we get a target price of $13.73. Our combined average result was a comprehensive, balanced, and valued approach to analyzing Sun Country Airlines. This ensured that none of our models ran astray and all of our models were robust. For this, we get a combined average target price of $13.39, which represents a downside of 19.96%. I'll now turn it to Jared with our investment risks.
Thanks, Bailey. We have identified 4 primary investment risks for Sun Country. Risks A and B are firm-specific, whereas C and D are industry-sensitive. Risk A recognizes the threats to the Amazon partnership's longevity. Risk B highlights how Sun Country's low name recognition will affect their ability to expand operations in the future. Risk C emphasizes how future macroeconomic downturn will disproportionately affect the airline, being that they are a budget carrier. And Risk D notes that environmental safety standards increasing in the future will eat into Sun Country's profitability. Thank you, and we will now open up for questions.
Not going too back, just like that, we put down one more back.
I can kick it off. Sell ratings are always bold. management has sometimes in the past shown up to these presentations, and so I applaud the courage. Just wondering, if there was a representative from Sun Country here, are there recommendations you would give them about, how they could improve their business or their business model, or is this more of just kind of an industry and victim of their placement?
Oh, that is a great question. I would like to think that our thesis in the ultra low cost carrier market is typically due to its cyclicality is something to avoid. In terms of our recommendation for leadership, Sun Country needs to try harder to expand out of Minneapolis-St. Paul. 80% of their operations are based out of there, and they lack the ability to grow if they just continue to stay in Minneapolis. So I would encourage management to try harder to expand to other markets.
Maybe as an add-on to that response, we've all seen in the news some of the consolidation attempts in the airline industry. Do you see Sun Country as a potential buyer, a potential target, and does that change your recommendation at all?
So yeah, most likely, if we were to see Sun Country merge or be acquired, it most likely be a horizontal acquisition by another company, where it most likely be Sun Country being acquired by another company. So typically when that happens, is a good thing for the company being acquired. That being said, this is just speculation at the time. We wouldn't foresee this happening in the near future. That would be a fundamental, be a huge change to the investor if they're acquired. But with that just currently being speculation, it's not something that we would factor into our model, and that's why we do state our thesis based on the fact that it is just like I was saying, speculation. Good question, thank you.
What do you think of their capital structure?
So I do think Sun Country is probably on the more healthy side of airlines. They have a lot lower debt, and the management team is conservative in the way that they grow. They try not to take on so much debt like other airlines like Spirit or Frontier. And I do think that Sun Country does offer a lot of liquidity with their cash as well as their short-term investments. However, they still are debt heavy considering the airline industry that they're in.
Okay, I work for a hedge fund per se, I don't, but you guys are on the sell side. I'm calling you, you don't know if I'm long, short, or what. What are the buy side people saying?
So
Not buy side people, the people who are saying buy.
to buy Sun Country,
Yeah.
yep. So I do think a lot of people are looking at Sun Country as a conservative growing airline that has the ability to produce revenue consistently. However, even if Sun Country is to grow at 5% above our 3% CAGR that we calculated, why would I buy Sun Country when I can go buy a AAA corporate bond at 5.5% or other investments? There's just no money to be made with Sun Country, and so it is our thesis that the sell recommendation is probably better than the buy.
I mean, you mentioned, it sounds like you have a concern on the durability of the Amazon freight relationship, which seems to be probably a real key component of the positive side of this story. What gives you that pause? What is it that you see that makes you think Amazon is vulnerable in the long run?
Yep, so it wouldn't be as much so that Sun Country or Amazon themselves would have threats to their company or their contract. It's more so being that Sun Country is filling a role for Amazon. They aren't the role for Amazon. We've seen them before have Atlas as a partner. Atlas moved on, they went to Asia. Now they're kind of dealing with Temu and that type of thing. Sun Country currently is just filling that role for a cargo jet for Amazon, over actually, like I said, being that role. When they're in that industry, if Sun Country were to be higher priced than, say, another airline that could compete with them, before that 2037 contract extension that we put in 2030, we could see Amazon move on to a different company, a different airline that could do this for a cheaper price.
If the company decided to basically just scale themselves back to being a charter and freight business, do you think it might change your opinion or revalue the company if it were strictly a charter and freight business?
Yeah. Although we do see the cargo sector being a benefit for Amazon at this time, it currently isn't profitable. That is mostly just due to research and development costs. They're trying to train in a lot more pilots and that type of thing. That being said, having it be another avenue is good, and this would not change our thesis, as we do see it as being a positive for the company at this time.
two-stage model, but just curious, help me understand why 3% and 2% feels to me is very similar.
Yeah, so we'll pull up. So this is my analysis approach to Sun Country Airlines. So you can see on the far right, we have 3%. So that is my CAGR that I calculated with my forecast. And these are our 2024 E expectation numbers. We also have 2024A as well. And so that's where we got our 3% CAGR. The company did issue guidance, and we took the conservative end of the guidance due to the nature that airlines are cyclical, and you want to make sure you enter at the best possible price point.
I like your conservatism, but sometimes issuing a sell recommendation based on your time horizon could be tricky. So I'm just curious, like, why would you put 3%? Did you look at the revenue growth, the macro trend, the company management in terms of their operational improvement, things of that nature? By the way, what is your kind of time horizon for that sell recommendation?
Yes. So our sell price is a one-year target, and so the company did issue guidance that they expect the passenger market to cool by 10 to 12%. So we took that 12% number and factored it into our 2024 E expectation. And then they said cargo block hours will increase. We also took the conservative end. We also took the conservative end, 61%, and that got us our full year revenue calculation. And then we added that into our matrix, and then the math just came out to 3% overall until 2029.
Okay.
Yep. Go on.
Is there any one catalyst that would change, let's say a month from now, news comes out, that would change your recommendation from a sell to a buy? Like any one variable?
I think if Sun Country was to get acquired, that would be the only reason for us to change our thesis. With Apollo Global selling out, you're going to see a flood of stock entering the market. It's just inherently going to push down the price. In our eyes, there's no reason to buy Sun Country today because you're just going to see the share price get beat up over the course of these next few months.
I haven't seen a Benjamin Graham model in a while, so I'm just curious why you guys chose that valuation methodology as part of it.
Yes, so because Sun Country offers no dividend, we wanted to find another alternative model that we could also use as kind of like a benchmark. And so we use that to help reinforce our multiples estimate. And we also like that the Benjamin Graham model incorporates the cost of debt via the AAA corporate bond. And so that way we can help project, with the rate environment as well as just everything shifting in the macro, this allowed us to help have a little bit stronger benchmark.
When you looked at the opportunity or lack of opportunity, you noticed this concentration around one airport. The 1%, I want to view the 1% at other airports as a negative, but is there any way that can be spun as a positive? 1 minute.
Yeah, for Sun Country, that totally can be. One thing of that, seeing that they have all their infrastructure in one place, with Terminal 2 being recently renovated, still renovations are going on, having a good hub is a solid thing. Also having all your executives in one area, understanding the market very well, could be a positive thing for Sun Country. That being said, we did state the negatives of it. That being it's harder to enter those new markets, especially when they're already so concentrated. Some of the new markets they're trying to enter include DFW, Phoenix, and Las Vegas. Those are some of the only other airports outside of smaller local regional airports such as Milwaukee and Madison that they actually have flights that aren't direct flights back to MSP. Those airports, like I said, are very concentrated, and it is challenging for the airline to expand from the MSP base.
Maybe just my final question. From your work, seeing the competition in ultra low-cost carriers, would you say that you would be open to ever owning an ultra low-cost carrier, or does the whole industry just be scrubbed out to yourself?